In this lesson, we are going to discuss investing versus speculating. The first question we should ask is, why do we care? What difference does it make to us? Well, you probably heard about Warren Buffett's two rules of investing. The first rule being, don't lose money. The second rule being, don't forget rule number one. Ultimately, with investing, better results are achieved through better decision making. Being able to identify which situations make of sound investment opportunities and which are mere unintelligent speculations allows you to make less mistakes and lose less. So we care because investing mistakes end up costing you money, and because we can avoid mistakes by staying away from speculations, or at least be knowledgeable and contain those situations in which we speculate. Now, this lesson is based on the teachings of Benjamin Graham. Ben Graham is considered the father of value investing. He was born in 1894 and died in 1976. Not only he invented the philosophy of value investing, Ben Graham had also invented the analysis profession. Before Graham, there were statisticians, people who were mostly concerned with the history of dividends that a company distributed, or with Dow theory, technical analysis, or things of that sort. Graham was the first to bring forth the concept of really digging deep into understanding the business behind a stock and intelligently assessing its prospects. It is less known, but Graham was also the first quantitative investor. In his book, The Intelligent Investor, he introduces two mechanical, rule-based investment strategies. They were called stock selection for the defensive investor, this was one, and the second was stock selection for the enterprising investor. So those are essentially algorithms that anyone can apply systematically in his or her investment portfolio. Now, amazingly, those strategies still beat the market even 70 years after becoming public. So in my website, inteldavidson.com, we are providing a list of stocks based on stock selection for the defensive investor strategy. And we show that this strategy still beats the market, and does so with very little volatility. Undoubtedly, Graham was a genius. So one of the first things that Graham had taught in his value investing classes, and also he writes about in his security analysis book, which he co-authored with David Dodd, is the definition of investing. Now he goes back to fundamentally ask, what is an investment? And then Graham and Dodd defined it as such. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Each part of the definition is meaningful, so we have to examine every word carefully. There was no coincidence in Graham's and Dodd's choice of words. Let's start. An investment operation is one which, upon thorough analysis, an investment is an operation. It's not a bond or a stock or any other object. An investment is an act, an operation which is performed rather than an object which is selected. Graham specifically indicated thorough analysis. He wants to dismiss shallow analysis or no analysis at all. No operation can be considered as an investment if it's not based on thorough analysis. Promises safety of principal. An investment cannot hold a chance under reasonable circumstances to make you lose everything. If it would, it wouldn't be an investment. It would be a speculation, a gamble maybe. Sure, the principal may deteriorate in value, but Graham's point is that the principal in an investment is something with value and cannot be vanished overnight. Now think of biotech stocks or even stock options. They do not count as investments under Graham's standards. Any binary situation for that matter, that if you are right, you win handsomely, and if you are wrong, you lose everything, is speculation. And the satisfactory return. Now, Graham did not write market beating return or superior returns or even good returns. He deliberately used the term a satisfactory return. Now, sometimes satisfactory return is just the long term interest rate if it is achieved with low volatility and high standards of safety. Other times, satisfactory return must be higher than the market, to compensate for added volatility or reduced liquidity. Satisfactory return is subjective and changes from one investor to the next. So finally, the obvious. Operations not meeting these standards are speculative. So let's look now at some operations and think whether those count as investment or speculations under Graham's standards. So when you're at work talking with a colleague by the water cooler or coffee machine, and this person says, "Hey, did you see that Google stock? It's now entering the AI, artificial intelligence space, and it's going to disrupt the universe. And all my Wall Street friends are piling up on the stock. They say it is going to double by end of year. I bought a truckload myself. Whomever is not investing now in Google stock is a complete moron." Would buying Google stock then be considered an investment? Of course not. It lacks the element of thorough analysis. It is sheer speculation. But if that conversation was just a lead triggering you to perform critical reading of SEC filings or serious analysis reports, followed by purchasing the stock intelligently with a system in place on how long to hold it and when to buy more and when to sell, that may have been considered as an investment. You are not required to do the analysis yourself if you're not an investment professional, but you are required to critically assess the thorough analysis that someone else had done. Getting hot tips from friends or colleagues doesn't account for thorough analysis. What if you open the Wall Street Journal or Seeking Alpha or any other blogs or financial newspaper for that matter and find a very compelling analysis piece recommending a stock? Would buying based on that recommendation be an investment or speculation? Well, while I have written quite a few analysis papers and published them in Seeking Alpha and in my own blog, I believe that reliance on such reports would be speculating. The problem with stock recommendation on blogs and on papers is that they are usually not part of a system for investing. They are sporadic pieces of thought, rather. Often they are not followed on. You read a great recommendations, you buy the stock, it goes up, then what? When do you sell? What should you do? The author moves on and rarely goes back and tells you what to do with a position. That is true for the other side of the coin as well. You buy a stock, it goes down. Then what? Should you pile up more? Should you sell and cut your losses? What's the system? I think that when you're buying a stock based on a recommendation in a newspaper or a blog, what it really is speculation. I've done just that over the years. Sometimes I would make a profit, sometimes I would lose. I figured that it is not a good way to make money over the long term, so I quit doing it. Currently, I'm only following systems and not individual detached recommendations. Now to a tricky question. Should technical analysis be considered an investment operation or speculation? For us die-hard value investing fans, technical analysis is a big no-no. We are led to believe that any form of technical analysis is speculation. And I do agree that most technical analysis operations are indeed forms of speculation. If you look at a chart long enough, you will find patterns, even if those patterns are merely random walks. I do not think, this is the thorough analysis that Graham had intended for. When technical analysis is concerned, I think we need to apply higher standards of scrutiny. Technical analysis should be based on serious research in the realm of behavioral finance. A technical analysis investing system should be tested rigorously over many years and many markets. Only then can technical analysis be considered as investing. In the portfolios that we highlight, that we have in taldavidson.com, we often include elements of momentum investing. Now, momentum is actually a manifestation of technical analysis. But the way we use momentum is based on serious academic research, as well as our own rigorous testing. Our momentum strategies have performed well over decades, and we believe that the momentum investing strategies we have on our website constitute as investing rather than speculation. We would like to provide two examples of operations which we think undoubtedly would count as investment operations. The first is discretionary stock selection. Most value investors operate in that way. They maintain a concentrated portfolio of just a handful of stocks, each chosen through elaborate analysis process. Professional value investors study their companies well, digging deep into both quantitative and qualitative aspects. They form a sense of a company's value and hold their stocks until that value is realized or exceeded. This is definitely one of the soundest ways to invest. The second example is quantitative investment strategies. So you can call them systematic strategies, rule based systems, or active robo advisors. But they all mean the same thing. They are based on algorithms which determine which stocks to buy and when, which stocks to sell and when. The thorough analysis is not done in the level of each individual stock, it is done in a portfolio level. You see, the system is built upon rigorous study and deep analysis, but once the system is built, it is left alone to do its magic. The conclusion is that buying stocks and selling stocks, for it to be considered as investing, one should have a system. That system may be discretionary or quantitative, but nevertheless, it's a system. If you buy stocks and it's not part of a system, most chances are that you are speculating. If you intend to invest, then develop a system, regardless if the system is discretionary or quantitative. Benjamin Graham, he went further than that. Not only he had defined the difference between investment and speculation, but he also claimed that many investments have a speculative element to them. And to understand that further, let's read a paragraph from chapter 5 of his book, Security Analysis. So Ben Graham said on the relation of the future to investment and speculation. A bit hard, but we will explain. It may be said with some approximation to the truth that investment is grounded on the past, whereas speculation looks primarily to the future. But this statement is far from complete. Both investment and speculation must meet the test of the future. They are subject to its vicissitudes and are judged by its verdict. But what we have said about the analyst and the future applies equally well to the concept of investment. For investment, the future is essentially something to be guarded against, then be profited from. If the future brings improvement, so much the better. But investment as such cannot be founded in an important degree upon the expectation of improvement. Speculation, on the other hand, may always properly and often soundly derive its basis and justification from prospective developments that differ from past performance. Now, Graham suggests that we look at the stock price as a combination of an investment portion and a speculative portion. The portion which is based on facts, on past performance, on the assets that a company has, that's the investment portion. But often a stock price is higher than if it were only reflecting its past performance or value of its assets. The surplus or the remainder is attributed to how well the stocks will perform into the future. A stock with wonderful prospects would be priced higher and sometimes significantly higher than its current worth of assets or even its run rate of earnings. That portion is the speculative portion. When you buy a stock, you pay a portion for its factual net worth today, and then another portion for what it will do or not do in the future. So that latter part is a speculative element, and you can see it in almost every investment one makes. So maybe surprisingly, Graham has asserted that intelligent speculation is justified as long as the investment characteristics are not compromised. It's okay to have speculative elements in your investments as long as you understand the nature and magnitude of that speculative portion and you contain it. Graham made the distinction between intelligent speculation, being the taking of risk that appears justified after careful weighing of the pros and cons, and unintelligent speculation, being risk taking without adequate study of the situation. Let's give an example. Now, this is a real life example of a stock I owned in early 2016, Best Buy. At that time, I wasn't 100% quantitative, so I had several discretionary investments which I bought after careful analysis. So you see, my thesis for this investment was that there was no speculative element in buying Best Buy shares at the price that they were trading at in the beginning of 2016. The SEC filings of the end of 2015, which I highlight here, they show a modest valuation multiples. The valuation is low based on average income level, and below average revenue figure. I guess that the sentiment was negative for that stock at that time. Investors were worried of Amazon stealing the business of all big box retailers and were fleeing the stock altogether. But if you thought that in the long term Best Buy would be able to protect its current level of revenues and profitability, even without any growth, then the price you pay for it then was a sound investment. It was based on thorough analysis because I've read the SEC filings, listened to the conference calls, read analyst reports, and spent hours trying to understand the nature of the business before I made my claims. It provided safety of principle because there was a real business with tangible customer demand, and the price I paid was well justified by the cash flows paid by the company. I didn't know what would be the return, but I figured that even market returns would be considered satisfactory to me. I didn't pay up for dreams, for growth, so there wasn't any speculative element in this investment. Now, contrast that to investing today, we're at the end of 2017, in FANG stocks, the Facebook, Amazon's, Netflix, and Google's of the world. Their valuation is based on a hypothesis that revenues and profitability will extend well into the future. The speculative element in their valuation is far greater than their investment portion. So let's consider how our three principles of investing approach stack up to Graham's teaching on investing versus speculating. The first principle is have an edge by being rational. I believe it is clear that if you're investing based on thorough research, then you are being rational. And when you're speculating unintelligently, you are being irrational. Secondly, to be able to pay only for the investment portion and keep the speculative portion to a minimum and maybe to zero, you need to be contrarian. If you're thinking like everyone else, then most chances are that you are paying up for dreams, hence speculating. Lastly, my third principle is that it works because it doesn't always work. Well, even if you're making only investment decisions and you're magically refrain from ever speculating, no one can assure you that all your investing decisions will work well. That's the interesting thing about decision making. You can make the best decisions, but it doesn't necessarily mean that you will always win. I encourage you to learn more about my investing approach following the link I have here. So let's recap. You can avoid losses by not speculating. The best way I know to identify speculations is by using Graham's definition. An investment operation is one which, upon thorough analysis, provides safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. We also learned that almost every investment we make has some speculative elements to it. We need to be careful. We made a claim about investments, and that they can be discretionary, having a portfolio of carefully handpicked stocks, or rule-based quantitative strategies. The strategies on taldavidson.com are 100% investments. They are based on thorough research and they are apply value investing principles, which provides safety of principle and we think more than a satisfactory return. Looking forward to seeing you in the next lesson. If you haven't yet signed up for free to get your quant investing starter kit, please be sure to do so. Happy investing.